scheme. So we have to accordingly respond. Next 40 minutes, we are going to take a session. Why we kept 40 minutes is minimum 40 to aana chahiye. Just by attending the session also, who knows, you may get 40 marks. Okay. So welcome to the session, including our YouTube viewers. Just a second, I need to share screen. Okay, so visible, Kiran? Okay. So the session is meant for 40 minutes. Okay, will be conducted by me, Shetty sir, myself. Believing in yourself is the first secret of success. First examination, FR. Believe in yourself, Deepa. When you believe in yourself, success 100% is expected to come. The schedule, first 10 minutes I'll be discussing generic about the course, 20 minutes specific about the exam, last 8 minutes general discussion, no subject specific question. Don't ask me India's 103, that question number we have that. Last 2 minutes high by, because now the time has to be used in the best possible way. That's why we kept it for 40 minutes. First exam, hence be more relaxed. So this is the most important fact, especially at CA final level, because you're all having extra pressure, because you're very close to the market. So many pressures will be there. But more importantly, you have to be cautiously, artificially, naturally be more relaxed. First impression is the best impression. First exam goes well. All 8 exams, 7 exams goes well, balance. First exam goes here and there. You may still come back. No problem. Sometimes FR may be tough. SFM may be tough. Don't worry. But still, put your extra effort to ensure that first exam goes extremely well. Now we have only new scheme. Financial statements are extremely important. Indias. There are 2 small topics, integrated reporting and CSR. Maintaining extremely good pace. Extremely good pace is important, it being the first paper. Many of us are not used to write. We are all laptops, what you call mobile, etc. You are not used to write. The writing speed is extremely important. All of you, please improve your pace, PACE. That's why even in the exam hall, please try to be at a good pace. Don't reduce your pace. FR is a high scoring paper. I always say aim at 100. 129 mark paper, Ashok, aim at 100. FR, SFM, IDT. Okay, you should score extremely high. Other papers, reasonably. Read question carefully and answer accordingly. For example, India is 103. When fair value of NC is given, it means it's a full goodwill. So last you see, oh sir, fair value I didn't see only. It's of no use. Fair value of NCI is given. It means you have to go by full goodwill method. Extremely important working notes. Give your working notes. Stepwise approach is also appreciated by the valuer. Appreciated. So FR, even if your final answer doesn't match, you may still get almost 90 plus 95% marks. Final answer is important, but step always carries more marks. Final answer tallied, but no workings, you may get only 50 marks. So final answer match for 1 or 2 questions with best working, you may get a 90 plus. It being a core subject of our course, chartered accountant, financial reporting is accounts. That's why enjoy writing this paper. Limited syllabus. New scheme, only division 2. Division 1 is not applicable. Glance and go, just in case if there's glance. Division 2, in and out, you should know. It starts with the assets. Assets on the top, equity and liabilities down. Use the term PPE. Don't use the word fixed asset because you are all company account students. Outside, you can use the word fixed asset. But company accounts, you cannot use the word fixed asset. Consider net worth for Indians and not turnover. Net worth. Register. Last time I'm telling you before exam. Okay. Net worth. And the word used is greater than or equal to. Equal to symbol is also covered. It is covered in phase 1 itself. Use the right terms. For example, India's 2, You may use the word NRV. India is 41, use the word fair value. They may be similar, but use the right word. Do's and don'ts. Bhumika, Odama, unmute.
Do's in the last page of sheet, 5 to 10 minutes, write points for each question.
Full Josh, Bhumika.
In the last page or rough sheet, 5 to 10 minutes, write points for each answer, each question to be attempted.
1:45, they will give you the question paper. Be there again. First exam, be there by 12 o'clock. Get comfortable with the area, etc. Restroom, etc. Find out all those things. Next exam, at least by 1 o'clock, you be there. Don't go beyond 1 o'clock. By mistake also. Okay, from whichever area you are traveling. Now, all my exams throughout, different exams are written. Moment a question paper is given. So what I'll do is I'll see 1:45 to see question paper seeing time. So I normally don't start with the first question except in DT. I just turn last question, fifth question I see. And in the last page, I write on the top, rough sheet. Question number 4, these are the points. Question, scribble it. On 5 to 10 minutes, not 1:45 to 2 o'clock, you have to visualize. What are the questions you have to write? 2 o'clock, moment the answer sheet is given, where you're eligible to write, keep on scribbling the important points related to that. Then, maybe at 2:10 you can start writing. By mistake, if you miss some point, suddenly something get distracted, you can go to the last page and get back to that. It's an extremely useful tip, which I followed in all my exam. You also follow it. But that 5 to 10 minutes, you have to cover up in the pace. Your speed you should cover. Normally, it helps because since you have already written majority of the point, don't waste your time in half an hour there. I said only 5 to 10 minutes writing short scribbling. But scribbling again, sometimes you will, what did I write? What did I write? That's a waste. Okay. Write in an understanding way, you understand. Others need not understand the last page. Samajh mein aa gaya? Rough sheet. Then again, repetition of the same thing. Every now and I say FR paper. Now it's only FR. Working notes. What am I? Heroine.
Working notes, steps.
Sorry.
Working notes, steps. Reference to correct Ind AS number if known. Reference to Companies Act if known. Write correct question number including sub-questions. Attempt extra question compulsorily. If out of syllabus, then full marks.
So question number. Ind AS number you should write. Ind AS number with the name. So Ind AS 2. You have to write the name also. It is not just as per Ind AS 2 Allah. You write with the title. And if you don't know, God bless you. It is unfortunate if you don't know at this stage. So if you don't know, don't write. And Companies Act sections also wherever required, you can record. Sub-questions, 4A, 4B. You are supposed to write all sub-questions together. Even if extreme case, if you written here and there, it's okay. Don'ts.
Don'ts. Writing Ind AS number when partly sure or not sure. Relaxing before 3 hours. Unnecessary tension. Exam is
at 3. Exam gets out at 5 o'clock. One day your exam gets out at 6:30. Don't relax before the time allotted to you. Okay. Don't carry any unwanted, unnecessary tension. The great APJ Abdul Kalam says,
Success is vehicle
which moves on wheel called hard work. I repeat, success is a vehicle which moves on wheel called hard work. Yes, wheels get tar, everything gets pressurized, and it's a hard work for tire. But the journey is impossible without the fuel called self-confidence. So without the tire, also probably some of the vehicles you can push, but without fuel, it is a waste. Actually, waste exercise. That's a self-confidence is the key to success. Okay, fair enough. Now let us quickly Sargatorsan on the 10-15 minutes of entire FR. This portion you will understand only if you have attended FR. If you are not understand, if you are not attended, you may not understand much, but still worth listening, at least 5 to 10 points. Okay, those who attended, you should know. FR new syllabus mainly consists of financial statements, Ind AS, integrated reporting, and CSR. Financial statements have been defined in section 240 of the Companies Act 2013. Balance sheet, the word use this P&L account, not statement of P&L. Formatally, they say statement of P&L. For NPO, it's called IND account. Cash flow statement. So C, if it is applicable, most of the cases is applicable. Explanatory notes, OPC, etc. need not have to follow cash flow statement. There are three divisions under Schedule 3. Division 1, meant for non-Ind AS small companies. Your syllabus is Division 2, Ind AS companies, and Division 3 is for NBFC, glance it. In all the three divisions, part 1 is balance sheet. So C is additional in division 2 and statement of P&L. Section says it's P&L account, whereas here is the word statement of P&L. OCI is shown inside the P&L because in India, balance sheet we have two statement approach. P&L we follow single statement approach. Division 2, the financial statement Sapna is as per company's Indian accounting and standard rules. You have to by heart, remember this, 2015. On the top, assets, non-current asset, then current asset. Husband on the top. Okay, that's what we are saying for assets. Non-current asset. First 6 are fixed asset. PPE, capital work in progress, investment property, land, building or both. Tangible. Next 3 are intangible. Goodwill, other intangible asset under development. Then biological assets, that is a living animal or plant other than the bearer plant. So BFDO. So first 3 tangible, next 3 intangible, then BFDO, boyfriend, dura ododanta. So biological asset, financial asset. Financial assets is Risha. ITL, investments, trade receivable, loans. Trade receivable can be long-term or long-term or short-term. Deferred tax asset, other non-current assets. Then current asset, IFCO, inventory is always current. Then financial asset, current tax asset is always current because the name only says other current assets. So, and under financial asset, ITC, BLO, investments, cash and cash equivalent, bank balance other than mentioned here, then loans and others. This is the format for balance sheet. You must by heart this. Equity and liabilities down. Equity separately show equity share capital, other equity. Preference share capital should be a part of the other equity if it is not a debt component. Liabilities, non-current liabilities, FPDO, financial liability, provision, deferred tax, and other non-current liability. Current liabilities are almost same, but the order is slightly changing. FOPC, financial. Here the word used is what? Financial. All of you listening?
Yes, sir.
Yeah. So financial liability, here also financial liabilities. Here there is a provision, but it is a third item provision. Here there is a deferred tax liability. Here the word is this current tax liability. Then here it is a trade payable. So trade payable is always part of the financial liabilities. So non-currently FPDO, financial liability, provision, deferred, and others is always there. Okay. FOPC by heart the format. Coming to the statement of P&L, first portion is same in division 1 and division 2. ROTE, ROTE, revenue from operation, other income, total income, expenses. Expenses, first 3 are inventory related. Cost of material consumed, including opening and closing stock adjustment, purchase of stock in trade, changes in finished goods, work in progress, and stock in trade. Okay. Opening minus closing. Positive, positive, negative means which is the bracket. Then trading account after purchase, then we write employee expenses. Here also employee benefit expenses. Then finance cost, depreciation and amortization, other expenses. There is no word called extraordinary in India's. That's why it is PBET, profit before exceptional items and tax. Remove exceptional item, remove tax, become profit after tax. Here again, current tax and deferred tax. Don't discuss about MAT here because it is a IFRS format. MAT is an Indian phenomenon. Okay, so it is a part of the tax, but not in the format. Next, if there is a discontinued operation, profit as well as the tax has to be shown. Then the total profit. Then this is beauty. Other comprehensive income, OCI, which will not be reclassified, which will be classified. Which will not be reclassified, tax related to the same. Which will be reclassified, tax related to the same. This plus the normal profit you add, that is called total comprehensive income. Under Ind AS, EPS has to be shown under 3 categories. EPS for continuing operation, discontinued operation, discontinued operation, then discontinued and continuing operation. This is the P&L beauties, PBET and EPS under 3 categories. Division 2, there is no extraordinary item. Show OCI separately. EPS has to be shown under 3 RMRs. Consolidated financial statement format is same. Only extra point is in the division 1 we used to call it minority interest. In your syllabus it's called a non-controlling interest in division 2, which will be shown separately outside the equity, below equity. Understanding? Are you comfortable with the speed?
Yes, sir.
Okay, very good. Division 3 special point, previous year figures have to be given unless first year of operation. Then Ind AS, they are the convergent form of IFRS. Almost 95% of IFRS plus carve in minus carve out. For listed companies or unlisted companies, If the net worth is greater than or equal to 500 crore, applicable from 16-17 with the previous year column of 15-16. Whereas if it is less than 500 crore, listed company compulsorily comes under phase 2, whereas unlisted company, one more ceiling more than or equal to 250 crore, then only they will be applicable. The phase 3 is not yet notified. Same point in a different way. Include JASH also. JASH. Now, India has special points. 2 guiding principles throughout India is fair value, substance over form. Fair value, substance over form. Fair value is defined in India's 113. Orderly transaction between market participant as a measurement date. Substance or form is don't go by the mere formality, go by the true spirit of the transaction. Go by the true spirit of the transaction. Right. So now, so almost every question make a reference to Schedule 3. There will be a lot of sub questions. India's 18, India's 19, etc. Make a reference to the India's as per India's 3, as per India's 103, as per India's every time. Number with the title. India's as per India's 103, singular commas, business combinations. You must mention every time when you answer. Are you understanding, Baba?
Yes.
Fine. And almost every question you have to make a reference from there to Schedule 3. Sir, EPS India's 33. As per Schedule 3, Division 2, Part 2, at the end, EPS has to be shown in under 3 categories. Make a reference. Tax expense, when you talk about India's 12, in the P&L, tax expense has to be shown as current tax as well as deferred tax. In the P&L, just write the extract. It will definitely fetch you extra mark. Okay? Fetch you extra mark. If they give 105, carry forward to SFM. Okay. Okay. Don't be so serious. Smile. India's 101. Okay. 100 series are IFRS. IFRS 1 to 17 are called India's 101 to India's 117. Whereas those form IAS which are not yet converted into IFRS, or they want to continue like that, they are called the same number. If I say IAS 40, India is 40. IAS 41, India is 41. Whereas what IFRS, what they say 1 to 17, you have to add 100 to that. I hope you got it. So we have 1 to 17 with the 2 being minus. India's 101, first time adoption. There it's called IFRS. Here it's called first time adoption of India's. Whenever you are adopting IFRS for the first time, for example, last year only my net worth became 250 crores. Okay. And it became 250 crore. So from this year, when you apply, so all the adjustments have to be routed through reserves and surplus. Okay. It has to be routed through other equity or reserves and surplus. India's 102 share-based payment. Okay. Whenever there is a share-based payment, it can be equity or cash settled. Equity means it will appear as a liability. Cash means reduction from the bank account. 103 business combination, important, 5 marks, 10 marks, 15 marks, 20 marks. Goodwill computation, either total goodwill approach or partial goodwill approach. Whenever they give you NCI valuation, either at fair value or proportionate of net asset, it is always full goodwill. How to go by full goodwill? Consideration paid plus NCI at whatever value given, total, plus total net asset bar total equity, that is called total goodwill. Whereas if it is a partial goodwill, consideration what you have paid minus your stake in X1, A1, C1, D1. X1 is the share capital, A1 is the capital profit, C1 is the bonus share, D1 is the revaluation of the fair value change. So your share minus body, partial goodwill. Next, IFRS suggests only one method called acquisition method, but India's 103 carve out is the deviation. They say for common control transactions, we can also go by pooling of interest method. Acquisition method is normally followed for common control transactions, like holding company getting, subsidiary company getting merged with the holding company. So they say, why should you bother about acquisition method? Pooling of interest method. Under acquisition method, positive is called goodwill, negative is called capital reserve. Under common control method, pooling of interest method, whatever profit or loss, it has to go to capital reserve. Positive or negative. Special point it is positive. Capital reserve can be even negative. So whereas acquisition method, I repeat, acquisition method is goodwill. Negative is called gain on bargain purchase. You have to prefix those words. Gain on bargain purchase, which is ultimately taken to capital reserve. That is the word used to Kiran Egde. So whereas if it is a common control method, for which pooling of interest method, positive or negative, it is always a capital reserve, always capital reserve. Demerger is a classic example of common control transaction, capital reserve. 104 is not there in syllabus. 105, two aspects. Non-current asset held for sale and discontinued operation. This is a balance sheet item. This is a P&L item. So assets can be two RMRs. Non-current and current. Current chod do. So for scope exclusion, it excludes current assets by the title only. Under non-current, two RMRs. So which are normally PP, etc., which I'm using. Why the hell I should cover here? It comes under India as 16. Suppose if you set aside some asset, you want to retire it, get it what you call sold, then it's called non-current asset held for sale. It will be valued at the carrying amount or fair value less cost to sell, whichever is less. Non-current asset. This is the valuation of non-current asset held for sale. Discontinued operation. India is mainly focused on what is already discontinued, even though somewhere they talk about discontinuing operation. Discontinued operation impact in the P&L, whatever the profit with the tax impact has to be shown. 106 is not there. 107, 109 is the most important standard called the financial instrument. The disclosure requirement. How do you show the embedded derivative? How do you show the equity debt component? How is the interconnection? All these are discussed in 107. 109 is financial instrument and India is 32. These are the three related standards. India is 109, India is 107, and India is 32. Financial instruments, it can be financial liability. What is financial instrument? One entity's asset becoming another entity liability. Sirisha Limited issues debentures. For her, it is a liability. For me, it is an investment. Okay. So all those are called financial instruments. It can be financial liability. They can ask you multiple questions on how do you segregate the component into debt into equity? How much is the debt? How much equity component? Go through it. 108 is the operating segment. It is like a departmental accounts. How do you, if you have got multiple operations activities, how do you present? So for operating segment, first 10% criteria. 10% or more of the total revenue. Internal revenue, external revenue, total karke into 10%. If any segment constitute 10% or more, 10% or Sudiksha more, okay, of the total revenue, or 10% or more of the results. Yeah, when I say Etishwar, very good. Results, when I say total of all profits or total of all loss segment, individually without bothering about sign, whichever is higher into 10%. And the total or 10% or more of the total assets. When I say total asset, it should exclude. No doubt, IFRS, we never have a concept called fictitious asset. By mistake, in Indian scenario, if you include minus karo, and income tax asset also has to be minus. It is 108. So 10% criteria. When you do this 10% criteria, ensure that at least 75% external revenue is covered. If it is not covered, select any other segment to make it as at least 75% external revenue. Management can always choose even 1% also. Some new idea, they can obviously so. So these are the three criteria. 10% or more of the revenue. Start with the P&L, balance sheet, so P&L, end with the profit and balance sheet assets. And 75% of external revenue. And the third one is management choice. Fourth one is not there, drinking juice. Yeah. So, right. Because we have a session immediately after this, some more. Right. So then CODM is a function. Okay. Chief Operating Decision Maker is also extremely important. Right. So 110, consolidated financial statement. Extremely important. Last 20 exams, including old scheme, if you see, 18 times they've asked us. 18 times. That too on balance sheet. Okay. Right. So now, consolidated financial statements, India is 110. First refer 103 for Goodwill. Goodwill is from 103. When there is a holding subsidiary relationship, parent subsidiary relationship, associate relationship, joint venture, JASH, joint venture, associate, subsidiary, and holding company, this is called a group. How do you merge this? That is called consolidated financial statement. 2 within bracket 46 defines holding company, H holding company. That's why 2 within bracket 87 defines what is a subsidiary company. Mainly, majority of the composition of board of directors, more than half of the total voting power, which is mainly equity share capital. So H Limited has made investment in 6 lakh. Equity share capital of S Limited is, let's say, 10 lakh. That means 60% face value or number you have to consider, and not a what you call at cost. Because Infosys face value 5 rupees. You would have purchased at 2,000 rupees. They are incomparable data. So there are 6 plus 2 steps we coined. Step 1, determination of shareholding pattern in subsidiary company. Step 2, subsidiary company's other equity, 2 RMRs. Pre-acquisition profit and post-acquisition profit. Pre-acquisition profit again 2 RMRs. Okay. Holding company stake and NCI. So share capital 2 RMRs, X1, X2. Pre-acquisition profit A1, A2. Post-acquisition profit step, keep it open. Less depreciation based on the revaluation step. Less if there is an unrealized profit, upstream approach. Step number 6. So because the profit of the subsidiary company includes something which is a unrealized. Upstream means subsidiary company sold to parent company. So then deduct karke, then 2 RMRs. Left side green ink double box B1. So ashtabanda hakbital olagidibidi, don't use it late. Okay. And right side is B2. Adu bichu bidbodu, tondre illa. Okay. B1 should not be touched. Then step 2A, bonus shares, 2 RMRs, C1, C2. Step 2B, revaluation of the fair value change. Fair value change can be for asset, liability, whatever. Today, India is anything it can happen. So whatever the fair value change, the total, okay, be careful with the language. Sometimes they say in the middle of the year, actually, there's a acquisition taking place, depreciation adjustment, etc. will be there. Extremely careful information. So fair value changes, 2 RMRs, D1, D2. This is step 2. Step 3 is computation of goodwill. Refer 103. Total goodwill athava partial goodwill. Partial goodwill means very simple. Consideration paid minus X1, A1, C1, D1. Don't touch B1. Ashtabanda madi itidi value. Next, step 4, computation of NCI. It depends on step 3. If it is a full goodwill method, whatever NCI you have calculated in step 3, add B2. Add B2. Because goodwill is as on date of acquisition. As on date of acquisition, whereas NCI is as on the date of reporting. 30th September, if I acquired subsidiary company, on that day, what is the goodwill? That means you have to consider only pre-acquisition. Should not consider post-acquisition, Kiran. Very good. Whereas when you're talking about NCI, NCI is as on the date of reporting. That means it's the 31st March. So September 30th to next 6 months. Reporting can be after 10 years also. So today you acquire, and if there is no change in the shareholding pattern, your goodwill remains the same, okay, subject to impairment. Next 10 years, only B2, post-acquisition profit keep on changing. Understanding? Step number 5. Step number 5 is intercompany owings. Debtors, creditors, BR, BP, etc. minus money from the concerned debtors and concerned creditors. Step number 6 is unrealized profit. If it is upstream approach, take it directly to right side of step number 2. Where if it is downstream, find out the profit, Suresh. Left side reduce from the P&L, right side reduce from the what you call concerned asset, inventory or equipment. One equipment problem, depreciation adjustment also you have to consider. The next point is consolidated balance sheet. Balance sheet kaise karna hai? All the items of holding company line by line you consider, except investment in subsidiary company that gets knocked off. Every other item of the subsidiary company add line by line, except those items which are considered in step 1 to 6. Share capital was already considered, other equity is already considered. Those items chod everything you add, and special item on the equity component B1, greening double box, ashtabanda you have done, that you have to add it here and close it. Balance sheet tally. Then they may ask consolidated P&L account, again line by line, exclude revenue transaction. So recently, new scheme, they are not added some masala, intercompany cross holding. Like holding company is holding you, yeah, I will also hold you, something like that. If it is so, you have to use simultaneously. In the regular class, we have done step by step. If there is a different reporting date, whatever the balance sheet of subsidiary company, material changes first do the double entry and redraft a trial balance and then do the consolidation, etc. Chain holding. Start with the what you call the small subsidiary and then Usha, Nisha and Sandhya problem. If you recall XYZ problem, etc. Extremely important. And in India, it's only effective control. So X to Y, let's say 60, Y to Z, if it is 60, effectively it will become 36%. X to Y 60, Y to Z 60, 36%. So you need to consider 60 ka 60. Okay. So and 36% normally may not be chain holding unless they say that is the effective control. The word used is effective control. The control definition is PLR, power link variable return. Then the words are punch words. Very good. Many of you are recalling. I'm happy for you. So this is about India's 110. I took a little extra time and also connected to India's 103. Next, India's 110, joint arrangements. Joint arrangements can be of two types. So one is a jointly controlled entity. It is separately covered down If you can see here, India's 28 birthday, okay, 28, okay. Jointly controlled entity, like me and Bhumika being partners in some entity. Separate books of account you maintain. Or jointly controlled asset. Sapna and Sirisha are owning Kudremukha iron pipeline. 60% held by Sirisha, 40% held by Sapna. So in Sirisha's book, whatever asset, whatever liability, etc., 60% you take. Sapna's book you take 40%. It's called proportionate consolidation. India's 110 talks about total consolidation. Mera Baap Ka Mala, everything you add, then NCI shows separately. Under India's 111, Sapna's book, her own individual asset plus 40% assets of joint arrangements. So you have to consider joint assets or joint operation like a mining, etc. One special point is when there's a transaction between the venturers, amongst the venturers. Sapna purchased an asset for 10 lakh. She sold it to Sirisha for 15 lakh. That time, Sapna should recognize the profit belonging to Sirisha, sir. Purchased at 10, sold it to joint venture at 15 lakh. 5 lakh is not a profit. 5 lakh into Sirisha's share, 60%. Because Sapna cannot make profit by selling to herself. That one point, you please take extra care. India's 112 disclosure again. So what is the subsidiary? What is the joint venture? What is the associate? Which is the country of origin? What is the domicile, etc. You disclose. India's 113 extremely important. It is a 3 related standard. 3 words. Fair value measurement. Fair value means OMM. Orderly is the price for selling or price for buying in an orderly transaction between market participant as on a measurement date. So what are the 3 approaches you can follow? Market value approach, income approach, or cost approach. What are the hierarchies? Level 1, level 2, level 3. Now, if you are comparing 2 items which are absolutely similar, classic example may be Maruti Suzuki Brezza, Vitara Brezza with the Toyota. Toyota has the branding, the cross branding concept. Toyota also has a similar car. What is it called? Lanza, not Lanza. What is it called? Toyota Vitara Brezza ditto car, okay? Urban cruiser, okay? Trust me. So Maruti Suzuki, same car, Toyota will be putting the seal called urban cruiser and selling it. They are comparable. Level 1. Second one is similar one is called level 2. So maybe Maruti Vitara Brezza with the Creta, or maybe Hyundai, some similar cars, not identical. Level 3 is incomparable. You don't have Beetle car, okay, of that international brand. There may not be a similar car at all. Or Hummer, you would have heard of Hummer, MS Dhoni, somewhere you had bought. So that car, there's no comparison. They're called level 3. Level 1 is something like identical. Level 2 is what? Similar. And level 3 is what? Unobservable inputs. When you don't have observable inputs. 114, defer. It is not in the syllabus. 115, extremely important again. Revenue from contract with customers. It talks about the normal revenue as well as the construction contract. 5 conditions have to be satisfied. Cooper, okay. Issue the contract, performance obligation, price, allocation of the price, then recognize the revenue when all certification conditions are satisfied. Okay. There also you need to see what is the method which the entity is following. So company being, it has to follow accrual method of accounting only. Cash basis will never be discussed. Small transaction you may not be able to practically follow, but to the extent possible you have to follow. Service concession agreement, boot, bolt, etc. Build, own, operate, transfer, build, own, lease and transfer. All those transactions also please go to. India's 116. Leases. Lease means your asset being used by someone else. Asset belonging to the enterprise being used by someone else for which they give a consideration. Lump sum or series. In the books of lesser, there is a concept called operating and finance even now. Shetty sir Shabiana, Sirisha's marriage for 2-3 days. I am the lessor, she is the lessee. For her, it is a rental, take it as an expense. For me, it is a fixed asset, claim it as a depreciation, PPE. Finance lease is Sundaram Motors, Sudha Madam purchasing a car on hire purchase by paying 10 lakh rupees for over 5 years. Sundaram Motors are actually the legal owners. So Sudha Madam will become the beneficial owner. In the books of lesser, that concept exists. Present value of the gross investment will be shown as a receivable. Unearned finance income will be deferred and it will be recognized over the lease period. Lessee's book alli, there is no such segregation. India's 116, it is only ROEA, right of use asset, recognize at present value of the minimum lease payment. What lease liability, what you are paying, okay? That one with all the direct cost, incidental direct cost, plus present value, the decommissioning cost, etc. It has to be recognized. Lessee's book. Fair enough. Next, small value items, low value items, lease, etc. are may be excluded from accounting if you don't want to show the same. Right. So next, 117 is not applicable now. Okay, it's not made mandatory. Next, IAS standards, which has been considered the India's, which series number 1. India's 1, presentation of the finance statement, talk about schedule 3, going concern, accrual and consistency, 3 fundamental accounting assumptions. Inventory, cost or NRV, whichever is less. Special point to be noted is about the fixed factory overhead. Fixed special note has happened. Fixed factory, variable overhead is based on actual production. Fixed factory overhead is normally based on normal production. However, if the actual production is more than the normal production, stop at the normal actual. So do based on the actual production, not based on the normal production. I repeat, variable overheads are always based on actual production. Fixed overhead normally based on normal production. But if the actual output is more than the normal production, why the hell you should do a normal production? Do it on actual production. So easy to remember. When the actual output is more, variable overhead as well as fixed overhead both are based on actual production. When the actual output is lesser, variable overhead is anyhow based on the actual production. Fixed overhead will be based on the normal production. The regular class, there's a beautiful notes on that. Yeah. Okay. Next, India's 7, statement of cash flow, classified into operating, investing, and financing. Anything related to the PPE, intangible assets, and investments other than cash equivalent is investing activity. Interest received, dividend received, etc. Then financing activity, basically share capital, loans, and security premium. Dividend paid is always a financing activity, whether it's a financial enterprise or not. Operating is mainly P&L account with current asset, current liability movement. Show it. Only operating activity can be shown under direct or indirect. Everything else, there's only one presentation. India's 8, accounting policies are the principles which you are supposed to follow. SLM is an accounting policy. WDV is an accounting policy. FIFO is an accounting policy. If there is any change, it has to be done retrospective effect. Change in accounting estimate, it has to be done with the prospective effect. Errors have to be effected to the opening balance of the reserves and surplus, other equity. Now, one important point is anything related to depreciation, whether it's an accounting policy change or estimate change, because of the specific mention in India 16, it's always a prospective effect. Prospective effect. India's 10, events after reporting period, 560 SCA, adjusting event and non-adjusting. Financial statement 31st March, it gets over. Date of reporting. 31st March is the date of reporting. And financial statements are approved on 30th June. Between these 3 months, whatever events happen, 2 months. If the conditions existing on 31st March, but I got to know about this later, they are called adjusting events. Let's say 10th of March, I sold the goods to someone. He has become insolvent by 30th March, but I got to know it only on 10th of April, adjusting event. Whereas if I made a sale on 2nd of April, how can I go back and pass an entry on 31st March? It's called non-adjusting event. Dividend is no more a subsequent event now. Okay. Dividend has to be accounted only when it is declared, not in the year of a proposal. 100 times I told in the regular class. Next, India's 12, income tax. So there is a difference between accounting income and taxable income. So the differences is leading to the deferred taxes. So India's follow balance sheet approach. They say carrying amount and fair value. Tax base, sorry. So very important, 1 or 2 extra points I want to tell you here. Carrying amount means amount at which it is carried in the books. So carrying amount is equal to original cost minus accumulated depreciation minus accumulated impairment already done, if any, if you're done earlier. This is a carrying amount. Okay. So now when you talk about the deferred taxes, so carrying amount, you be loyal to the FR. Today I'm talking about FR only. Carrying amount is 100 lakh. But in income tax, it's WD with a fair value or the tax base. Okay, it's 80 lakh. 100 lakh is the cost, carrying amount, sorry. 80 lakh is the, tax base. 100 minus 80, you get a debit balance. That means you have to create deferred tax liability. This is a debit balance. So that's why you have to create deferred tax liability. So this is called a taxable temporary differences. Income tax, you already saw how more depreciation. Okay, that in the future you have to pay more taxes. 100 lakh is in the books of account. 80 lakh is in the income tax. WDF assets I'm talking about. Liabilities are ulta. That means you have to pay more tax in the future because income tax and WDV is lesser. You have to pay more taxes. You have to create liability, deferred tax liability. At a simple language, carrying amount minus assets, always keep it positive. If there's a liability, write it as a bracket, which is the bracket. And if you get carrying amount minus tax base, if you get positive, that means asset is positive. You have to create deferred tax liability for completing double entry. If you get negative, you have to create deferred tax asset. First, taxable temporary difference and what? Deductible temporary differences. There is no permanent difference concept discussed in India as well because anyway it is out of the discussion. One special point in India's 103 for goodwill we should never do deferred taxation. We should never do that. Okay. However, other value changes. One important point is A limited absorbs B limited. B limited's carrying amount. Okay. In the books of account, let's say 100 lakh. Okay. But I recognize here at 300 lakh in the fair value because I recognize fair value. So they may not give any other information. So now for the purpose of India's 12, that fair value recognized in A limited will become a carrying amount. Are you understanding? And carrying amount in the transferor company, assuming it was same in the income tax, will become tax base. So I repeat this. A limited absorbs B limited. B limited had a carrying amount 100 lakh. Today its market value is around 300 lakh. In the books in A limited, I record it as 300 lakh. That will become a carrying amount. Income tax base of B limited is not given. So the carrying amount given in the B limited itself will become a tax base. So carrying amount will become a fair value and that, fair value will become a carrying amount and carrying amount of the B limited will become a tax base. Those who attended the class, you may understand, others you may not. I'm sorry because it's slightly complicated. Okay. Next, India 16, simple, tangible. So it should be tangible assets. The definition uses the first pair of plant, which is incidental to manufacture. So leasing purpose, renting purpose, etc. Okay, property and equipment is administrative purpose. That's the way the definition has been given. And it is normally valued at cost model. Fair value model once in 3 to 5 years. And depreciation, you have to go by component method of depreciation wherever applicable. Fair value, when you do it, upward is revaluation surplus. Downward is P&L. Any up and down, ensure that by doing so, original depreciation is not affected. India's 19, there are 4 categories of employee benefit: short-term, debit to P&L, long-term, and post-retirement. There are 2 options. Either you can go by defined contribution scheme, like a provident fund, where employer pays 12% and forgets it. Defined benefit scheme, you have to go by 7-step approach, Saptabadi steps approach, which Asha Madam had told, gratuity, etc. And termination benefit, just like short-term, account and close it. And connect it to India's 102 share-based payment. Next, India's 1920. Don't see this. This is number in you. India's 20. Okay. Is government grant, ditto like AS12. Okay. So capital grants. Sorry, there is no concept called capital reserve. Only exception. Okay. Everything is income approach. Capital grant, revenue grant, then and loan, etc. also will be considered a grant to the extent of subsidy, etc. given. India's 21. So normally in accounts, Indian standards, we have only 2 currency. Here we have 3 currencies. Functional currency, the environment in which check if the entity is functioning. Presentation currency, normally functional currency. If it is different, you will report the same. And foreign currencies other than the functional currency. Okay. Any exchange difference is normally taken to the P&L account. India's 23. Any borrowing cost related to the qualifying asset. Borrowing cost is IFE, interest, then finance charges on the lease transaction and exchange difference related to qualifying asset. Till it is ready to use, it has to be capitalized. Balance has to be transferred to P&L. So related party disclosure, it can be 2 kinds of relationship. Control base, like holding and subsidiary. Disclosure is must. Significant influence, girlfriend. Disclose only if it's when there is a related party transaction. India's 27, when there is a holding subsidiary relationship. The statements are called separate financial statement. Just discuss about Schedule 3. Investment in associates and joint venture. Okay. You have to follow equity method. Equity method is nothing but a partner's capital account. Next, 29 is not there. Financial statement we discuss. 33, we discuss earning per share, 2 RMRs. Patesh divided by weighted average number of shares. That's called basic EPS. Profit available to equity shareholder. Profit after tax available to equity shareholder is called Patesh. Profit minus preference dividend if it is declared. If it is cumulative, you minus it always, and divided by weighted average. Weightage is for the number of days or months. Diluted is so where your existing profit get diluted amongst employees when the options are given. Convertible preference shares are converted to equity share. Debentures are converted to equity share. Employees, there is no change in the numerator, only denominator changes. When the debenture is changed, the numerator also has to be changed with the net savings in the interest. Assuming interest is 10 lakh, you have to add only 7 lakh because 30% of tax advantage. Whereas preference share is converted to equity share, add only 10 lakh rupees. Don't bother about the what you call tax because dividend is never allowed as an expenditure and DDT is not applicable now. Next, India is 34, interim financial reporting. It is nothing but a financial reporting, either complete or condensed. Condensed is what is suggested in the India. There are two views. Entire period can be taken as 1 year and divided into 3/4. That's called integral view. Discrete is DIS, CRETE. So each period is considered independent. That's called discrete view. Income tax always based on weighted average. Normally asked question. Impairment of asset. Kara. Impairment of the Kara. Even you eat in Nagarjuna, Nandini, etc. Kara, body parts get impaired. When the carrying amount is greater than recoverable amount, then impairment loss is equal to carrying amount minus recoverable amount, which has to be transferred to P&L account. Goodwill is the first item to be reversed when there is CGU, etc. Once it has been debited to goodwill has been debited to P&L, you cannot reverse goodwill. Other assets, to the extent what would have been continued had you follow the normal depreciation, can be taken. Next, India 37, provisions. Provision is a liability. Liability is OA, present obligation leading to outflow of economic resources. Contingent liability is a possible obligation or present obligation which doesn't satisfy other conditions. Contingent asset, you may disclose above 95%. There's a table given in the regular notes. Please go to that. India's 38, ditto like India 16. Only difference is INP, identifiable, non-monetary, without physical substance. Research cost is always debited to P&L account. Development cost capitalized if 6 traffic conditions are satisfied. India's 40, investment property, land, building or both. Always cost model valuation. You cannot follow revaluation of fair value. However, within the bracket, disclose the fair value. Investment in building, outer column costs 300 lakh. Within the bracket, fair value 500 lakh. Disclosure is a must, but you cannot follow what you call the revaluation. India's 41, agriculture, okay, fair value less cost to sell. Every time, fair value less cost to sell, you have to follow. These consolidation steps I have already discussed. Integrated reporting and CS are the 2 extra topics. Integrated reporting is about how company thinks and does the business. Other big discussion. There are 6 categories of capital: intellectual capital, financial capital. There are 6 capital. You have to make a discussion on the same. And integrated report has got 8 contents. So what is the strategy followed? What is the objective? What is the performance? All 8 objectives copy paste ಮಾಡ್ಕೋಬೇಕು. Top 500 companies have been suggested to follow this integrated reporting by SEBI, okay, on a voluntary basis, not compulsory. CSR 135 of the Companies Act, read with schedule number 7. Okay, every company, public or private, Indian or foreign company, which satisfy any one of the following conditions. First, start with the profit. Net profit more than, start with the turnover, P&L account sales. So turnover more than 1,000 crores or profit more than 5 crores. Net worth more than 500 crores. Don't miss these words. Okay. So first start with the sales, highest figure 1,000. Profit the least figure 5 crores. Net worth is Beachka, which comes in the balance sheet 500 crores. If it's satisfied, CSR contribution 2% of the average profit of the last 3 years must be contributed. You have to create a CSR committee and comply with the provisions. And following shall not amount to CSR. Any project outside India, which is for a political party, which is in the ordinary course of business. And CSR can be done through company established under Section 8. CAPS Foundation, registered trust, you can do this. We are doing a science park project, etc. You can do that. Registered trust. CSR expenditure shall not be allowed as an explanation below 37(1) of the Income Tax Act. However, before that, 35 CCA, etc., it can be fully allowed. So, December 21, the questions, what are the questions asked? So, we have done an examination session earlier. You can go to that material. Any of my friends who are non-CAPS at listening, you can ask for it. They can send that examination session, complete detailed analysis of FR. So, these are the questions asked. India's 109 repeatedly asked good number of times. 101, 103. 103 for 15 marks last time. So, demerger also they might ask. Okay. then 27, 21, etc. Just glance it. Every examination, almost similar questions are going to be asked. Illi 110 was a big question for 16 marks. So July 21 only. Other questions are somewhat repetitive in nature, the concept. Then important areas, so which are discussed in the examination question. One sure question on 110, Goodwill, etc. Business combination, demerger, I'm expecting this time. Okay, CSR integrated, one theory for 5 marks. Schedule 3, with some mistakes they may present it. You have to rectify it. Mainly division 2. Important India's problems on these areas and theory from these areas. And order of preference, India's 110, 14, 16 mark question plus 4, 5 marks. Or India's 103. These two can be interchanged. One question normally out of these two for 14 to 20 marks. Then specific standard. These standards are continuously asked. 5 marks to 10 marks on this. Financial instrument is important again, 15, 25. Employee benefit is share basis payment, and the 10 marks for the schedule 3. Vika? Odaka.
Very good evening, sir. Harassed husband. Sir, I'm married for 17 years. Whenever we quarrel, my wife calls her brother from Bombay, who comes by next flight, punches me black and blue and flies back. My wife pays the ticket using my credit card. Please help me. Counselor, I'm very sorry to know your situation. In today's world, this has become quite common for most of us. Best is for you to shift to Bombay so that you can at least save the airfares. All the best. Pass with high marks.
So that's just for fun. Okay, those who understood, great. Okay, fine. So this is for the benefit of those who are not aware. Okay, so cap structure, etc. Just for information sake, when the batch starts, etc. We decide in every material we'll put it on the pass with high marks. God bless you. It being the first paper and enjoy the examination. Working notes, etc. Write properly. Okay, and aim at 100. Even if you end up with the 50, 60, don't worry. Okay, 60 also in FR. Other 3 paper 40s you passed here. I'm telling just okay. And FR or SFM, one of them will be easy. Okay. Sometimes FR is standard, sometimes SFM is standard. Okay. So be ready for it. Both will not be standard. 99% of the case. Auditing and law, reasonably standard only always. So FR and SFM, one paper, I'm expecting 100. You get about 60 also. Toughest of tough paper, one paper. 60, 40, 40. Estimate
140.
Agila. 60, 40, 40 agodilla. 60, 60, 40, 40. 2 papers you have to get 60, then 40, 40. Or one paper 80, then 3 paper 40. 60, 40, 40, 40. 60, 60, 40, 40. Or 80, 40, 40. Don't do that balancing act of 40, etc. But aim at 100, end up with 80 plus 5. Extreme case is the tough. Okay, think SFM is going to be easy. Okay, so Tarun Jagadish are going to handle the session on Saturday evening at 8 o'clock. Okay, so go and enjoy the exam. Maintain good, what you call health, physical, mental, all good health, and go and give your best shot. 3 hours, the best possible way you can, what you call present the paper, and each one of you are going to pass with high marks. And one point you remember, you being my student, you cannot fail in FR. If you can remember that, even if the toughest of tough paper, you keep writing, trust me, you'll get 60 plus 70 plus RMC. Keep rocking, keep enjoying.